Silver backwardation persists. Backwardation, it's not what I define as backwardation, but we're just going to use that word. I asked Keith Weiner about his opinion about backwardation and what backwardation means to him versus what it means to me. So this is his version of backwardation. I guess it kind of is. It means that silver spot prices that you can get in London are more expensive than New York futures prices. So I asked Keith, what does it mean when New York spot prices are more expensive than New York futures prices? He called that forward curve inversion instead of backwardation. Whatever term you use for it, forward curve inversion is a lot more extreme than silver backwardation between London and New York. But since we have backwardation between London and New York, meaning the premium on London is higher than the futures premium in New York, and let's see, it says here that London is now $2 higher than New York, and this backwardation has persisted since late December. This was the backwardation in October. It was from about the first week of October until the end of the month, about 2-3 weeks here. Japan is struggling with the yen, trying to keep it below 160 per dollar, and there are rumors that the United States or the Federal Reserve or the banking system or whatever it is that's acting on Japan's behalf or with Japan to strengthen the yen is moving together with them to keep the yen steady. Why does the yen need to be steady? Because the yen is a load-bearing candy cane of the monetary system.
Oh, that's a load-bearing candy cane, you clumsy oaf!
Because they are the most inflated currency in terms of debt to GDP, in terms of their Keynesian extremism. They've gone from kamikaze culture to kamikaze culture monetarily. Takaichi warns Japan is ready to act on speculative moves. That means that she's threatening to buy the yen if the yen goes below a certain amount. And she says here, very contradictory, as politicians often are, it is not for me as a prime minister to comment on matters, this is from Bloomberg, by the way, that should be determined by the market, but we will take all necessary measures to address speculative and highly abnormal movements. So she says, it's not for me to comment, but here I'm commenting and I'm saying we will do everything we can. And if you defy me, I will do whatever it is that I do as a Japanese prime minister. Takaichi didn't specify if her comments were related to Japanese government bond yields or the yen.
They're the same face! Doesn't anyone notice this? I feel like I'm taking crazy pills!
Government officials have recently made several warning comments regarding both markets. They are threatening the markets, and the markets are reacting. You'll see that in the next slide here. This is when Takaichi made her statement. It was the yen was collapsing towards 160, you see.
A mere $280 million of trading triggered chaos in Japan's $7.2 trillion government bond market. Ultra-long maturity bonds tumbled, generating a $41 billion wipeout and sending shockwaves globally. Yields surged to historic levels, stoking fears of a financial crisis reminiscent of fleeting historical moments like the Liz Truss episode in the UK. Analysts described the moves as extreme statistical anomalies, a 6 standard deviation shock. The market's reaction reveals that Japan's debt-laden economy is highly vulnerable to even small trades. Politics can attempt to influence markets, but the bond market's sheer scale and liquidity ultimately dominate, leaving policymakers scrambling to respond.
And then she said something, and then this happened. There was a little zigzag over there, and then it really started to fall. Falling here means strengthening. Instead of 158 per dollar, it's 155.67 per dollar. This is going to happen as politics fight the market. The market will ultimately win. Politics is too weak to deal with the awesomeness of the market. It cannot win, but it can wobble the graph for a while. But anyway, Japan bond wipeout was triggered by just $280 million of trading. That's it. This is also from Bloomberg. It took just $280 million of trading to push Japan's $7.2 trillion, whatever. These numbers don't mean anything anymore anyway. Government bond market into meltdown. That was the combined turnover of the country's benchmark ultra-long maturity bonds as they plummeted on Tuesday, unleashing a $41 billion wipeout across the Japanese curve that sent shockwaves through global markets. The rout pushed yields to record levels, stoked worries that Japan was heading into a Liz Truss moment. Remember Liz Truss? That was the prime minister that lasted about 6 hours in the UK, and there was this other treasury guy, or whatever they call it in England, Kwasi Kwarteng. He also got fired. Anyway, and he led U.S. Treasury Secretary Scott Bessent's secret research for what he called a 6 standard deviation move. That's a lot of standard deviations. I think 6 is the maximum. I don't know. I don't know how these statistics work. I don't really care either. It's just a lot. The 30 and 40-year bond notes were the worst hit during Tuesday's trading session, which several market participants described as the most chaotic in recent memory. Well, how long is their memory? If they have, memory problems, then it's not that much. But anyway, we're going to go to the next slide here, and now we're going to start talking about silver. So, what is going on in Shanghai? In Shanghai, the silver stocks in their exchanges are at a low that goes back to 2013. It's not a record low, but it's a recent low, and it keeps getting drained. We're at 506 tons, and this is the stuff that they take out in order to stockpile it for their solar panel manufacturing stuff. These are not stackers, these are industrial users, mainly drainage, Eli.
Across Shanghai's exchanges, silver inventories have dwindled to levels last seen in 2013, standing at just 506 tons. Industrial demand, especially for solar panel production, is driving this depletion. Unlike retail investors or collectors, these buyers require refined silver for manufacturing purposes, tightening physical supply. Backwardation persists, with London spot prices exceeding New York futures, complicating hedging strategies and restricting futures market liquidity. The imbalance prevents profitable shorting, indirectly supporting higher silver prices. Open interest remains moderate, indicating that speculative activity isn't the primary driver. Industrial demand and global supply constraints are quietly reshaping the silver market, signaling potential volatility and upward price pressure.
Silver backwardation persists. Backwardation, it's not what I define as backwardation, but we're just going to use that word. I asked Keith Weiner about his opinion about backwardation and what backwardation means to him versus what it means to me. So this is his version of backwardation. I guess it kind of is. It means that silver spot prices that you can get in London are more expensive than New York futures prices. So I asked Keith, what does it mean when New York spot prices are more expensive than New York futures prices? He called that forward curve inversion instead of backwardation. Whatever term you use for it, forward curve inversion is a lot more extreme than silver backwardation between London and New York. But since we have backwardation between London and New York, meaning the premium on London is higher than the futures premium in New York, and let's see, it says here that London is now $2 higher than New York, and this backwardation has persisted since late December. This was the backwardation in October. It was from about the first week of October until the end of the month, about 2-3 weeks here. And here we're going into a whole month, or even more than that if you count it from here, about a month and a half of backwardation. And backwardation practically in this sense means that if you want to sell short futures contracts in New York, you cannot hedge them profitably in London because the hedge is more expensive than the contract you're selling forward. You can't pocket a difference on the spread, and therefore it is not economical to do that. And that keeps the supply of contracts in New York lower since they are impossible to hedge profitably. The longer this persists, the higher the silver price is going to have to go until this backwardation is resolved.
Silver's price dynamics are complex. The backwardation between London and New York makes it costly to hedge futures, reducing contract availability. This isn't driven by ETFs, retail buyers, or speculative shorts, as fund holdings and open interest remain moderate. Even junk silver and collectible coins have negative premiums, revealing that market distortions aren't about retail hoarding. Industrial demand dominates current flows. The result is a tightly constrained market where supply struggles to meet real-world usage. Understanding this helps explain recent price spikes. The key takeaway: silver's value is increasingly dictated by fundamental industrial demand rather than traditional investment channels or derivative markets.
But anyway, so there's one problem in that, and it shows here that it's affecting the silver open interest market because open interest is not elevated here. There are no more contracts being sold now than otherwise. They're not very elevated at all. We have 155,000. I think it's 158,000, but this is pretty mid-tier, mid-level amount of contracts. And you'd think that short sellers would want to sell short here at $110 an ounce, but they can't, because to hedge it, it costs like $112 an ounce to hedge. So therefore, that keeps the supply of contracts low and elevates the futures contract. So this is not futures speculators that is driving the price here. Otherwise, you would see higher open interest, which is impossible right now. So what else could it be? Is it SLV? Is it retail ETF investors? No, it's not. Look at this. The blue line is the price of SLV. The black line is the amount of silver in the fund. We are not anywhere near a record high here. Record high was at silver squeeze at about 21,000 tons. We are now at, what is it, 16,000 tons. And you can see here at the 2011 high, it kind of was SLV related because this at that time was a record high of the amount of silver in the SLV fund. Here, we're not anywhere near that. And if you zoom in, you can see here, this little box shows the interplay between the blue and the red lines. The blue is the price of SLV. The black is the amount of silver in SLV, supposedly.
Silver miners currently trade at historically low valuations relative to the metal itself. Using metrics like the SIL ETF, silver miners appear undervalued despite rising silver prices, presenting a potential opportunity for investors seeking long-term exposure. Meanwhile, silver derivatives and bullion fluctuate dramatically, influenced more by industrial withdrawals than speculative forces. This disconnect between physical demand and miner valuation suggests strategic profit-taking could optimize portfolios. While prices remain volatile and unpredictable, industrial users bidding for silver ensures continued upward pressure. Investors should note the divergence. The market may undervalue miners today, even as silver inches higher, creating unique entry points.
And you have here, at the time that SLV, the fund share price was $55, which means that silver was about 60, 62. I think there's like a $5 or $6 difference between them, something like that. You can see here we had a certain amount, whatever that amount is, of silver in the fund. And now that we are at 95, even 97 now, as of this morning, dollars per share of SLV, we have about the same amount of silver from 55 to about 95. And it's been going down since this over here when silver was about 60. So it's not SLV hoarders, it's not retail buyers, it's not even institutional buyers of SLV. So it's not open interest in the futures, it's not SLV speculators, and also it's not the stackers either, because junk silver premiums are negative. They just plummeted to negative 3% suddenly. There was some kind of market adjustment here. We've been hovering around zero since November, and now there was a plummet to about negative 3%. So it costs more to buy a silver futures contract or silver in Shanghai in a contract than it does to buy junk silver, probably because it's not refined, and whoever's buying the silver now needs refined silver, and junk silver is not that. You can also see in Silver Eagles, the most expensive and popular of the silver. It's not even junk silver, it's more expensive. But even here you have a negative 2.55% premium on eBay. This is the main market for junk silver or silver coins. It's not the best price, but it's probably the most popular. I might be wrong about that, but a negative premium on eBay means, yeah, silver is cheaper than silver contracts. So there's something going on here. It's not the stackers, it's not the speculators. Now getting back to the point that I made at the beginning of the video.
Silver's volatility signals a deeper macroeconomic story. The weakening of the dollar and the looming banking crises may trigger a dramatic revaluation of precious metals. Historically, the dollar's value is tied to silver, and as confidence erodes, silver may reclaim its role as a global monetary standard. Future crises could ignite a surge, with industrial demand initially pushing prices, followed by broad investor adoption as the dollar falters. In this scenario, silver transforms from a commodity into the ultimate currency hedge. For global markets, this could mark the beginning of a systemic shift where prices are measured in ounces, not dollars.
It might make some sense to take some profits on gold, on silver bullion if you have your profits, and to put some of that in silver miners that pay a dividend. You can see here the silver to SIL. SIL is the main silver ETF, and it's a decent proxy for the value of silver miners, though it's not perfect. You can see here the higher this number is, the cheaper silver miners are relative to silver. You can see here was the silver crash of 2020, and we went up to about 1.025. We're at 0.923. This is very near an all-time high. The all-time highs are over here at about 1.025. So silver miners are very undervalued relative to the silver price. So if you don't have any silver miners and you've wanted to get a position in those, now is not the worst time to do that and take some profits from your silver, either ETFs or whatever you have. I wouldn't exactly sell your physical, but if you have any silver derivatives, silver bullion derivatives, it might be an interesting idea, though I don't recommend anything, and this is all entertainment. I'm very, very funny. to sell some of the silver bullion ETFs or derivatives that you have and get some silver miners. At this point, I don't know what to tell you in terms of where the silver price is going because I don't know who's responsible for this and how high the industrial users will bid the silver price in a desperate attempt to keep their silver stocks in use or available. It could go up to 150, could go up to 200, could go up to 300. It could top right here and go back to 50 in a week. Silver is that volatile. And just to cover my own butt, that I didn't say that it's not going to be volatile. It's going to be volatile. I don't know where the numbers are going to be. But in the end, silver is money because the dollar was born in silver. And now it appears to be dying in silver. It will have one last big flicker higher in the next banking crisis. But after that, it's not going to be the industrial users that are bidding silver higher. It will be everyone in the world as they really do abandon the dollar as the Fed slams the gas to save the banking system, and they will save it nominally, but it will be empty of all content as the silver value of the dollar goes to zero and the dollar price of silver goes to infinity. Nothing is priced in dollars anymore, and it all becomes priced in silver ounces. It's coming soon.